Welcome to the Me the Money Show. I'm Dan Barnes, Editorial Director at Markets Media Europe, and joining me today is Terry Flanagan, Editor of Markets Media. Terry, welcome back to the show.
Hey Dan, thanks for having me.
What have you got for us this week?
Well, one of the interesting stories that we did last week was on corporate bond trading, and specifically certainty of execution. And one of the manifestations of that we're seeing in the market is a trading protocol called portfolio trading. I'm sure you're familiar with it, Dan, but really it has sprung up just 2 or 3 years ago. It barely existed. And now some of these large institutional firms are saying that they expect to trade as much as 1/4 of their corporate bond volume in portfolio trading by the end of the year. Now, what portfolio trading is, rather than just trade one bond at a time, it trades dozens or possibly even hundreds at a time in one shot.
Now, that's really interesting because, of course, one of the challenges that bond portfolios often have is that if there are redemptions, and we saw this in the March sell-off, investors are pulling their money out. The portfolio manager tells the trader that we've got to redeem, say, 2 billion in cash. The first assets they can sell, of course, are the most liquid assets. But that means the portfolio ends up being heavily concentrated in illiquid assets. And that's no good for the rest of the investors still in the fund. So I can see why that would be valuable. But I'm amazed that 1/4 of their volume might be going through portfolio trading. That's an incredible increase. Is that through platforms or through brokers?
Well, I believe it's largely through platforms. For example, on TradeWeb, they said they did 43 billion of portfolio trading last year, full year 2019. This year, so far through the first half of the year, they did 60 billion. So and the run rate is ramping up. So one of the things that's interesting, I think, it's a little bit counterintuitive in a way. You think a lot of these corporate bonds are difficult to trade. They have liquidity constraints. But how do they trade them, put them all together, aggregate them, and trade them? So the way I like a very simplified analogy is if you think of a large rental car company or a transportation company, they're not going to buy vehicles one at a time and negotiate prices of each. They might not get the absolute best deal on every individual vehicle, but for the most part, they're going to get what they need at a good price. So that's what the institutions are really looking for: risk transfer, significant size risk transfer, and they don't need every single last basis point or two in price improvement. But as long as they get a real good price, which they are in portfolio trading, and get the deal done, it works for them.
Yeah, well, of course, that's the thing. If they're trying to get best execution, and that's across a whole range of different bonds, then the price improvement you might get on an individual bond, trading, say, at a smaller clip, and then going out into the market time and time again, wouldn't really stack up into the saving you get in terms of certainty of execution by trading that whole list of bonds all at the same time. Do you think that this is going to be something which is used more in volatile markets? Because that seems to be typically when you want certainty over price improvement.
Well, certainly we did see this highlighted through the intense volatility we saw in March. Institutions, they needed to get to transfer risk. They needed to get deals done. So this was a real priority doing portfolio bond trading. But it remains a priority. It's at a little more refined way, a little more subtle way, but they still need this risk transfer, and they are doing so in normal, not particularly volatile markets. One of the other things that was interesting, the buy side gentleman from Invesco that spoke at a recent fixed income conference said, this isn't something that breaks down a lot in terms of these portfolio trading deals. He said I think he said 130 portfolio transactions he entered into over the past several months. Only 2 of them ended up walking away from, and one of those was during just an incredibly volatile time. So he said, it's not a matter of deals breaking down and might not happening. These deals are getting done.
That's really good. That's great to hear. Fantastic. Terry, thanks very much.
Thank you, Dan.